Instruments of the Indonesian capital market. Indonesian capital market offers a wide range of financial instruments that allow companies to raise long-term funding and give investors various options to grow their wealth. These instruments are regulated by the Indonesian Financial Services Authority, aka OJK, and trade through the Indonesian Stock Exchange, aka IDX. Broadly, the instruments can be grouped into equity instruments, debt securities, collective investment schemes, and other derivative-based products. So there's 5 instruments of this. The first thing is equity instruments or securities representing ownership. The most common equity instrument in Indonesia is stocks or shares. When investors buy shares, they obtain ownership rights in company and may receive dividends when the company earns profits. Equity instruments also include trade issues, where companies offer new shares to existing shareholders, and warrants, which give investors the option to buy shares at a specific price within a certain period. These instruments are popular due to their potential for capital gains and relatively high liquidity. And the second instruments is debt securities or instrument representing borrowing. Debt securities allow companies or the government to borrow funds from public. The most widely known instruments are bonds, which pay periodic interest and return the principal at maturity. In Indonesia, debt instruments include corporate bonds, government bonds, and sukuk, which are the Islamic compliance bonds based on profit-sharing principles instead of interest. And the third instrument is collective investment schemes or managed investment products. Collective investment products pool funds from many investors and are managed by professional investment managers. The most common form is the mutual funds or reksadana, which can invest in stocks, bonds, money market instruments, or a combination of these. Other popular products include exchange traded funds or ETF, which trade on the stock exchange like regular shares but represent a diversified basket of assets. These instruments give investors access to diversified portfolios with relatively low capital. And the fourth instrument is derivative instruments. The Indonesian capital market also offers derivatives, which derive their value from underlying instruments such as stock or indices. Examples include stock index futures, which allow investors to speculate on or hedge against market movements. Although the derivative market in Indonesia is not as large as in some other countries, it continues to develop as regulation and investor sophistication improve. And the last instruments is other supporting instruments. Several additional products support capital market activities, including repurchase agreements, securities lending, and asset-based securities or aka EBA, which are created from pooled financial assets such as mortgage or consumer loans. These instruments help improve liquidity and provide alternative funding sources for companies. Overall, the diversity of instruments is the Indonesian capital market enables the investors to tailor their portfolios to different levels of risk, return expectation, and investment horizons. At the same time, they provide companies and government with vital sources of long-term financing to support economic growth.